Good morning, Doug. How's it going?
Hey, good. First Friday webinar of the new year. When did we start doing these? Was it COVID or
It
right
was.
before?
It was probably March or April of 2020. We were kind of leading edge with that. I mean that's
It's like it was on the ready to break out,
yeah,
and then we got on board.
yeah, and it was so new that our compliance people at the time didn't even know what to do with it because they hadn't really thought through it. And normally they would have made us go through a lot of hours of kind of process to get it approved, but then the whole industry was in a shipwreck situation. They're like, just go for it. We'll figure it out later. And that's what started these things.
Yeah, well, it's pretty cool. Not being someone who is naturally gifted with consistency, I've really appreciated these Fridays. For me, selfishly, you all, it keeps me accountable and helps me prepare and think. And so I've just really enjoyed these last couple of years doing these.
Yeah, it forces a certain level of understanding of a lot of moving parts that you come complacent with. I think one of those pieces of understanding and complacency I put on the warning was that New Year's workouts can be tough on formerly inactive muscles, so be careful out there. Hopefully you've had time to read through our disclaimers and realize these thoughts are the opinions of those of Gimbal Financial, registered investment advisor, and of no other entity, I don't think, other than the two people that you're looking at right here. So that's what this is, an opinion.
Yeah, a friend of mine, we were talking this morning, he said, where's the bottom in the stock market? And probably a few years ago, I would have answered that with some number. And now I would just say, my opinion is I have no clue, but we will know when the S&P 500 and the indices cross above their major moving averages. Why? Because we talk about it all the time. It's consistency. That's something we do look at every day, a couple times throughout the day.
It is it's impressive how helpful that can be. That we've mentioned Mark Minervini has a quote that says, maybe it's Patrick Walker that says that air is much better above the 200-day and much worse below that. And so if you look at the returns, historically that people have made, most of those have happened above the 200-day moving average, and most of the risk they've taken is below that.
Yeah, and speaking of risk, we have, next time you guys stop by the office, and please do, we have a chart that goes back to the beginning of the time, all the way to 2011, I think. And it's a stock chart. It's like one of those mountain charts that we look at all the time together. It goes to 2011. And one of the things I like about the chart is it highlights where rates were. And we're all excited about where interest rates are today, and we're treating it like it's some like abnormality. Like, oh my goodness, something pays better than 3%. What just happened? Well, I mean, it hasn't been that way for a few years, but really since kind of the beginning of time, or at least back to like the 60s, maybe the late 50s, interest rates around 5 have been kind of normal.
Yeah, I mean, low interest rates are what caused me to have curiosity about investing as a 16 or it was a 17. I was a 17-year-old me, and I've always been a saver, and I could get 3% in my savings account, and I wasn't content with that. I thought there has to be something better than 3%. I don't even know the math behind it. And so it was with those monies that I had that I went to a national brokerage company and opened my first investment account to try to get something higher. And the dividends on some utility stocks were paying almost 3 times out of pound at that point in time. I'm like, well, I would rather risk my capital and get 3 times the cash flow than what I'm getting on the savings at 3%. And now we're pretty excited about 3%, which is really funny.
It is funny. Yeah.
Yeah.
The chart was a good reality check for me. Again, we talk a lot about data here, and Hey, feelings are fine. I love to have good feelings. I can go into melancholy mode at times, but sometimes it's really good just to look at the numbers, and that's what we do.
I thought I'd go over some data before we jump into it. I will share this. So this is hanging on the wall in Gimbal World Headquarters conference room, and it's. I had a conversation with somebody yesterday that helped me think about it. I got to find where I put my notes here.
That was purchased at an art gallery in Nashville, Indiana. Caroline and I were down there a few years ago for our anniversary, and I saw that hanging on the wall of an art gallery, and I just thought it was cool.
It just says a lot. What it ultimately says is thank you to our clients who helped us get this business going, that retired or spent time at the phone company, because that was really just an honor to serve you and all the others that helped us early on. And probably a good percentage of youngsters don't even know what this thing is. It's pretty peculiar. One of our clients even had a phone booth in his basement. I don't know if you remember Fred and his phone booth, but that was really cool.
Yeah.
And so just thinking about this, I can't even recall which client I was talking to in the last month or so, that this is an analog device. And what she explained to me is there wasn't digital technology in that would actually tell the operators what coins you put in there.
Okay.
And so they had
Yeah.
to train the operators to recognize the coin that you dropped in was the appropriate coin for what they needed.
By sound?
By sound.
Okay.
Yeah. And so the evolution of that technology, you know, how quickly cell phones did away with pay telephones. But I was having a conversation with a salesman yesterday, and we were just talking about his role as a salesman and how it evolved, and how you know, when I started, there wasn't a thing called MapQuest. MapQuest was the predecessor to Google Maps, right? And
Yeah.
in MapQuest, you'd go on your computer, type in where you're at and where you're going, and then you'd print off the steps. And I remember driving around looking at those pieces of paper and like, where am I supposed to turn? And so that outdated the maps I used the early part of my career. And so then he was talking about when he'd rent a car, there was a thing that predated the GPS that you pay extra, and if you didn't get that, but for his meetings, and he would go to a town and maybe have 5 meetings a day, he would have to, the day before, print where you start in the hotel, where the first meeting was, and then print that MapQuest. Then he'd do that for the second one, from the meeting place to the third. And then he also had to have a pocket full of change for parking meters and for telephones, pay phones. And if you didn't have that change, you're in a world of hurt. And so
Rolling the dice.
just the evolution of the simple technology of him getting from one place to another really stirred my thoughts about that, and just appreciate the efforts people have done to get us to the technology we have today. And the thing that really caused that whole conversation with him about the details of that technology is he's younger than I am, but he spent in 20 years over 2,000 nights in hotels, which I had to just stop and think about what that looked.
Marriott points.
Yeah, that's what he was saying. He was telling me the different hotels, and you'd almost feel like a rock star. You wouldn't even remember what city you're in at that point. So it's just an interesting thing how technology evolves and how that impacts a lot of different things. And even those descriptions of that picture, just how many different technological advancements have evolved. You know, there was a time where we had a big box in Gimbal for our telephone system, and we don't have that anymore. Our telephone system is on this little box called my computer. And even in 2022, we replaced a technology company that was providing our phone with a older school one called Microsoft that could provide the same service. And so the evolution of things keeps changing. It's pretty amazing, and gives us optimism for the markets.
Oh, yeah. Like I was going down the path of what is going to be new and exciting, and Keith looked at several different stocks over the weekend. I looked at several, and they're there at the time. There wasn't too much to get excited about, and so I switched gears and just started Googling like what new technologies exist today. And one of the ones that popped up was actually not a new one to you and me, but it's probably new to a lot of people. CRISPR.
Okay, yeah.
And Keith and I were in a meeting in New York with a friend of ours, and he explained to us what CRISPR is. And it's basically like you're modifying DNA. And so if you could go in and make an enhancement or maybe remove a damaged piece of DNA to improve something, that could be health oriented things, that could be seed for crops. I mean, it could be helping create some bacteria to clean up an oil spill. I mean, there's all kinds of uses for this modification. And at the time, Keith and I heard about it, it seemed like super futuristic. And today, with mRNA vaccines and all types of new things out there, CRISPR type technologies are closer than ever. And we're not saying like, hey, put all your money in that. I'm just saying that's something that is new. We talk about artificial intelligence and what that, like OpenAI, ChatGPT, they're like the CRISPR technologies. There are new things being developed. And that's a lot of the innovation will come from those types of thinkers.
Absolutely. And it could be a minor modification, it could be a major modification. You don't ever know. The leaders in the market tend to be those that are revolutionary with their ideas. And so those are the stocks that grow, exponentially. But there's a lot of technology, I don't see one on my desk right now, the Post-it note. I mean, it just made millions and millions of dollars for 3M, and it was just a mistake that somebody had. So your technological developments can look a lot of different ways, and they don't even have to use electricity sometimes.
I think it could be tempting to say, okay, let's buy some of that, whatever that new thing is. Let's buy some of that. You've got time. The Post-it notes started to make money for 3M, and it showed up in their revenues and their earnings estimate revisions and things like in their sales. And so that's what we'll see. We'll see the data, and then you'll have time to get on board.
Yeah, the idea that you got to be right there in the moment is not necessarily true. I spent some time last year reading about the history of initial public offering stocks and how they trade, and I'm sure most of you wouldn't enjoy that read, but there's like in the olden days there was like, get me in on the IPO, I want in on that thing. Well, that's usually a sucker bet. They usually hit, drop, and then there's a stage, what we call stage 2 rounding, when it starts to rally from that. Some of them take off and stay up, but more often than not, they don't. There was a CRISPR stock that I'd watched last year, and while you were talking about it, I was just glancing at it over there, and it's down 80% from its high, which I think, let me look at it again. Well, it's been public quite a while. So it went public in 2016 and had a rally from that.
That's about when we heard of it.
Yeah, so it went public then, had a major rally, and was pretty much given most of that back. And that's not an endorsement, it's just historical information. So, well, you want to look at the markets again and just kind of give folks an update on what's going on out there?
Yeah, sounds good.
This is the weak sector of the market, the NASDAQ. We put these marks in last year as we were having conversations. We thought possibly this was acting like a bottom. Every bull market is initiated with what's called a follow-through day. That's usually between the 5th and 10th day after our bottom has been hit. Large volume comes in with an up day greater than 1%. In more volatile times, that's probably closer to a 2% up day with large volume. Had what seemed like a follow-through day there in late January, and immediately after that date, you started having major selling, and you kept hitting new lows till October. Over here, we said, "Is this the bottom?" Question mark.
And we forget just how brutal that was, because back in January, where you started, you go all the way down into March, you have a rally coming in April. Like I'm on spring break then.
Right.
And I can't remember if that was when Elon Musk mentioned that he might do something with Twitter. I think it was right around there.
Okay.
And there was some optimism.
Yeah.
There's like, okay, is this thing going to turn around? And each day is painful. And so it's easy to look back over 12 months and say, okay, this is what it is, big picture. But man, last year was really a hard year to be an investor.
It was brutal for a lot of folks. We did the very best that we can, I think, and I thought we did a wonderful job helping clients.
I'm pretty
with the market.
stoked about Gimbal's how we allocated accounts last
Yeah,
year.
and I mean, we put every once in a while we try to put our foot in the water and we get thumped in the
Yep.
ear. Did anybody ever do that to you? Thump you in the ear? That's how they did it back in the day. And you get that thump in the ear and say, okay, we're not going to give you more of the capital that our clients have worked so hard for, and we'll put it back on the sidelines. And so once we got to this bottom in October in the NASDAQ, it had a follow through day right around the 21st. And quickly gave that up. And I don't even think that any of the stocks that we've tried to buy in 2022 were NASDAQ. I think we just kind of, once we got out of that kind of sector of the market, we were looking otherwise for options. And there's nothing in the NASDAQ that says, boy, this is where you guys need to have all your money right now. It's just, today's an up day of 0.75%. Nothing so far into the new year says, yeah, let's jump in with both feet. Something that could change quickly. Here's the S&P 500. It topped a little later. It was probably in January right here where it topped last year and has held up much stronger than the NASDAQ. And
before you switch there, Keith, can you hover over September 27th? All right, yeah, just to the left. Keep going.
September 27th.
Yeah, that's
that's October.
Yeah. Right there. Okay, so right there was an interesting event. 10% of all the stocks in this index, so 50 of them were trading above their 200-day moving average on that day. And so 10%, 90% of the S&P 500, their individual charts were below the black lines.
Crazy.
And it's improved since then, but that's how ugly it was at the time. And these things take a while to shake out.
Yeah, it's just interesting watching what's going on out there. And I was thinking that
you're probably gonna look at the Dow before I interrupt you.
No, I was gonna look at the NASDAQ. Thought it was like the NASDAQ 100. I don't know the symbol of it all.
Oh, I don't know. Besides the ETF, I don't know.
Here it is.
Oh, nice. Yeah.
This is the NASDAQ without, I think the FANG is what I've been reading about in FANG stocks. And so it's still not showing much, reason to get excited out there. And so the new leaders are probably not going to be the Facebooks, Amazon, Netflix, Microsoft. I mean, those things.
Those charts look so bad. I mean, like, I know I've said this before, just because I used to like the downhill ski. I still do, just don't ever get the opportunity. But they look so bad. They look like stuff I like to ski down.
So this is not a this is not a recommendation.
That's like one of the better ones.
Yeah, this is.
And when I say better, I don't mean as good. I mean like comparatively.
Yeah. So if I take, and this is not bragging, this is just how we mark these charts up. So if I take these data boxes off, you can see on December 3rd, the position we had in Microsoft for clients last year, we sold at 320. And at the time, it looked like it was a bad sell to me. Yeah.
Go ahead.
Well, and yeah, it just told me, I was like, we just need to get out of it. And a few weeks later, it said, yeah, you guys should have held on. But then it wasn't long before that 320 price that we sold it for proved to be okay. And now if we liked this stock, the same stock we sold at 320, we could almost buy it 220. And it's not one that we're really that interested in right now. We may 6-8 weeks from now, it may be the one, but today it's not the one.
We're so bipolar on stocks. I mean, this thing could show us, a close above its 50-day and we could get excited again. I mean, yeah, so we're just listening to what the market's given. And the best thing you can do is hope you react well.
So there's not an urgency, I'd say, is what we would tell you today, that we have to jump in. The competition for stocks is CDs and money markets right now. So the stock market for probably, I don't know if it's a decade, I didn't look at it that long, it's been a long time, hasn't had a lot of competition from that. And so we're using a money market rather than bonds right now. I think most are anticipating the Federal Reserve to increase rates another 0.75% in 2023. We'll see if that happens. They alluded to they're not going to lower rates this year, so there's not an urgency to jump in that. But
I think another threat out there is we've talked about the 60-40 portfolios, the portfolios that have a decent percentage of them in bonds, and the bonds didn't hold up very well last year. And so, you might be hearing from TV personalities, hey, you can pick up interest, more than your money market in a bond or in a preferred stock or something like that. And yeah, the interest might be higher than your money market, but the risk to your capital is also higher. And so those portfolios, just when you thought, man, I'm gonna get a higher interest rate, they were trending down too.
Yeah, it was a difficult year. And like I said, I've mentioned Gerald Loeb and Your Battle for Investment Survival, that book, but that's what last year felt like. And who knows what 2023 will look like for clients. But I've got some notes I was going to jump into, but what do you have, Doug? Anything you want to kind of talk about?
I mean, I've got some other color towards charts, and I guess I would just say, if we could, let's take a look at the Dow real quick. I think the Dow is an interesting one since we've got this open, and I'll be real quick. But the Dow Jones indice has been the best of the three that we've looked at today. It did rise above its 200-day back in October, and keep in mind that's 30 stocks, and today about half of those stocks are individually performing greater than their 200-day moving average. But yet it started to overturn. And I think the best thing we could see in any of these markets is just some sideways action for a little while. And with some sideways action, what I mean is the lines for the ups and downs, they would just get a little tighter and they would go sideways to the right. And what that would do, I believe, is that would allow people, investors, to take a look at what's really happening, take a look at earnings as they come out, and say, hey, what type of risk do we want to be involved in? And it would settle things down a bit.
Yeah, I think that's right. And if you look at those Dow 30 stocks, they're probably not going to be the technology leading ones. There's going to be some tech stocks in there. Thought maybe this would give us a list of them, but
I ran through all of them. There's just not a lot of excitement out there.
Yeah. And so we'll see what 2023 has to offer. I ran across this quote this week, and I thought it was really thought-provoking. I played baseball in high school. I'm not bragging, but if you've played baseball, you have 3 strikes as a batter and then you're out. And if you watch the little kids playing and those pitches are coming everywhere and they're closing their eyes and swinging, the thing that, as I elevated in my skills, that you never wanted to do is what they call a called third strike, so that you're standing in the batter's box and a strike comes right down the middle and you don't swing at it. That's probably as humiliating as it gets for a baseball player, is to let a strike go by without giving it the college effort. So I give you that backdrop for those of you that aren't sports people, so you understand better what this quote really means here. So it said, remember, there aren't any called strikes in trading and investing. So you're not penalized for sitting in cash, is what he's saying. You can always take a wait and see approach, or take a few pitches before you even take a real swing. And And the current environment is a textbook example of how valuable a philosophy this can be when properly applied. And I just thought that was a great quote for what's going on out there, because we mentioned earlier, we took a couple of swings and last year, and we just didn't hit the ball. And so we said, we'll just wait and see what happens. And in 2023, very likely maybe a good year, but we're going to wait until the market gives us more indication that that's true.
Yeah, it'll let us know.
Well, I am about as boring as it gets. So I got funny stares from family members over the weekend when I had the extra day off, and so I've shown you this data point that I've kept.
I know.
I've kept this going for really since summer of 21. Really, this is, I think, when we started having some concerns, was probably the spring or summer of 21 about the market, and all this shows you is how many stocks are in our database, how many of those are trading below their 21-day moving average, how many are trading below their 50-day moving average, and how many are trading below their 200-day moving average. And so with the free time, I thought, I want to put my eyes on what that really means. And I was a bit traumatized when I actually worked through it. And I think I might be able to explain part of it on this screen right here. And I hadn't noticed. I don't know if you had noticed this, Doug, or maybe it's in ASQ. Let's see. There's we've shown it a few times in the past of what the markets are doing. Here it is in ASQ. All right, let me share the screen with y'all. And so this is what we would show you in past shows, the 10-day moving average of new highs and new lows, where the blue is the new highs. There's not a lot of new stocks hitting new highs. The red is the new lows. It's trending downward, which is a good sign. And then this one right above it is telling you that of all the stocks out there, the ones that go up, how much volume is in those versus the one that go down, how much volume is in those. And so on this indicator, it's starting to show a little more bullish look to it. Let me see here, the up is the blue. So we have a little bit more up volume than down volume. When we had the rally during the summer over here, you can see the up volume was really coming into it. And it's hard to have a rally without having more up volume than down volume. But this chart led to my New Year's Eve weekend. And I didn't see it on here till after I went through the whole episode. And so if you take the total of the stocks that they have here, the ups and the downs and the unchanged, it totals 4,821 companies. And I've been showing you this that shows you that there's 9,500 stocks in our database. And I'm going to continue to use that number. But as I decided, I'm going to go through all 9,600 stocks. Last week it was 9,600, and I'm going to go through all 9,600. So I literally know what's going on in the market, not just looking at the indices, but what is going on in the markets. And
Nobody knows how to party like you, but
I was like, oh, my eyes. It was brutal. It was brutal. I did it because I love you guys. And I wanted to have an understanding, and why there's not so many stocks is because mutual fund companies has really absorbed most of the investments in the marketplace. Since my career, I was a stockbroker when I started, but the mutual fund industry has grown exponentially, and now there's exchange traded funds. So they represent some of those 9,500 stocks. And there's real estate investment trust, closed-end funds. So actual companies is only half the number you see there. And I'm running out of time, but I'm going to go fast through this because it was pretty comical to me. When I looked at, I found a stock, Carvana, that it was down 99% from its high.
In a market where used cars shot through the roof.
99%. So it kind of, if you had Carvana and you worked it up and you wrote it all the way down, I'm sorry that was the situation. But we always say all stocks are speculative. But with the exchange traded funds, I'm just going to go through this quickly because I'm running out of time. There were religious exchange traded funds that I came across there. One enforced is invested by the Sharia law. Sorry to my Muslim friends if I didn't pronounce that right. There's a Catholic ETF. There's a Christian ETF. There's a biblically based ETF. There was a God Bless America ETF. The biblically based one's symbol was pray.
Man, I tell you.
The God Bless America symbol was y'all. There was political ones. One had a symbol of DEMZ. I don't know if you can figure out what that one was. There was a democracy one. There was a second vote one, which was a political one, which means they don't use ESG companies that are ran with ESG, environment, social, and governments. They feel like the second vote is what you do with your dollars, and it doesn't matter what the other things. And so there was that one. There was a humankind one. There were several equal gender pay ones. The curious ones I found, there was an altered state one. It invested in psychedelic things. And when I went to look at it today, it's out, that it's no longer exists. I looked at it over the weekend. It's not here this week. There was a bio threat one. There was a tail risk one. The tail risk means if something, 9/11 happens, we're investing that way. There was Meet Kevin. Do you know Meet Kevin?
No.
He's a YouTuber. It tells you how to invest. There was a breakfast one that invests in the breakfast food. There was a life goal one. There's a global aging one. There's a healthy heart one. NAACP fund. There are ETFs out there now that will short multiple times an individual stock, whether it's Apple, Amazon, all these things are out there. And with all the objectives, they all lost money, except for the inverse ones. The inverse ones didn't lose money. And so when I look at all that and think about it, is I think what we try to do is just keep it as simple as possible, because all those sexy sounding titles, the psychedelic one probably didn't even make it a year. I couldn't even go look at the chart at it anymore. And so we'd say all that to say this to you all is we're working hard on your behalf to try to keep things as simple as possible for you. And if you do have questions, we're happy to chase those down for you.
Hey, can I make one last plug? This is kind of housekeeping maintenance. If you have RMDs that you're curious about, your December 31st statement does not report those for 2023. That will be in January. However, we've got the data, so just reach out if that's something you're curious about.
All right. Well, in the meantime, you all just have a spectacular weekend, and we'll sure look forward to seeing you next time.